More on the markets ahead of the opening bell and where investors can find opportunities is Jim Paulsen. He's the chief investment strategist at the Leuthold Group. And Jim, everybody's worried about the trade talks. At least that's what the markets have been reflecting, kind of moving with every tweet, with every comment from the president. You say that you don't think the trade war could really have as much direct impact on the economy as some are believing at this point. Why is that?
Yeah, I don't know if that's true for sure, Becky, but I kind of think that the trade war is definitely a negative, and it's much more a negative for China than it is for us. No doubt about that. But I think we're talking about, even if we eliminated trade with China, it might be 0.5% off our GDP. A lot of that would go elsewhere, as some of it already is around the world, and eventually reoccur. I think the trade war is not, I'm not saying it's not a negative, but I think it's being outsized in terms of its negative impact. And I think if you take the negative of a trade war against all the policy stimulus we have, where we've dropped the 10-year yield by more than 1/2 since October, we've increased money supplies, we're juicing it with fiscal juice. I think the policy juice with appropriate lag is going to overwhelm negative from the trade flow.
So you think people should stay bullish here?
I do, Becky. I'm worried. I think the biggest risk we have is a confidence freeze, not fundamental. I think fundamentals are okay. I think if we fear ourselves into recession, we could do that. That's a real risk. And if the president keeps pushing this, that could happen. Also with the inverted curve scaring people. But if we avoid that, I think there could be big upside here. Look, I think maybe what we have is a fear bubble, and if we pop that and some greed returns, earnings estimates are going to start going up from a 1.5% 10-year Treasury yield. We're currently trading at a trailing PE multiple, which is below average since 1990. We've got full-on policy support, and we're climbing a wall of worry. There could be a lot of upside potential here if the fear bubble goes away. Maybe as much or more than the downside if we have a recession.
What has to happen to pop the fear bubble?
Well, I think we could do it a couple ways. We certainly could have a trade agreement announcement. We could have the Fed cut 50 and take the curve inversion out of the picture. Don't think that's most likely, but it's possible. Either of those could certainly help. Or we could just have data get better. And look, some of the data has been really good here, Becky. The Citigroup Economic Surprise Index was -70 at the end of June. It's now like -15 in the United States. And you look at retail sales, look at the leading indicator last week, look at unemployment claims. A lot of good data is going under the bridge. So it wouldn't take a lot more. If there's any upturn in manufacturing data, suddenly the whole economy would look pretty good, and I think the fear bubble could dissipate.
Mohammed, what do you think about that?
So, Jim, I'm with you in the sense that the economy is in a better place than what the markets and certainly what the fixed income market would suggest. And I'm with you that the two tails of this distribution are confidence-based. One is popping the fear bubble, as you said. That's the positive one. But the negative one is that we talk ourselves into recession. My concern is that the shape of this distribution is shifting, whereas you've got to pay much more attention to the tails than to the belly of the curve. And if that's the case, it puts the retail investor in a really hard position. So what do you tell the retail investor?
I totally agree with you, Mohammed. I think there's big moves probably in this market on both sides of the distribution. We could have a big downside or we could have a big upside. I don't think we're going to have a dull market in the next 12 months. So it does put you in a tough position. You have to make a bet. I'm tilted more bullishly, but I wouldn't be max bullish today because of the risk of a big downside event. I'd be somewhere between neutral to halfway towards my maximum risk on position today. And in that, I would take advantage of like Friday when it declines. I'd sell some of my more defensive stocks that everyone seems to love right now that helps them sleep good at night. And I would start picking away at some of the areas that have been hit hardest, like the emerging markets, or like industrials, like financials right now. I'd have a tilt on towards cyclicality, but it'd be a mild tilt. We're late in the cycle. We do have the chance of big downside risk, but I don't think that means you want to bury your head in the sand, because I think the more likely outcome is we go up rather than down.
So I understand that with one exception, which is the emerging market one. And undoubtedly, the valuations look really compelling there. I remind people that since 2012, EM equities have gone nowhere, while the S&P is up more than 150%. So I can see the valuation argument, but they are really the high beta ones. And if you look at the two sides of the distribution, do you really want to fade the U.S. in favor of EM equities at this stage?
Well, I wouldn't say I'd put all my eggs in that basket, but I would have a little bit of that. I think with fear right now at fever pitch, I think there's a good bet that a lot of the cyclical parts of the market are overdone on the downside, and the defensive parts, low vol investing, dividend aristocrats, utilities, staples, real estate are overdone. And there probably comes a period, if we don't have an imminent recession, where some of that gap is closed, I think, Mohammed. And I'm not saying you might ride with it forever, but I think off of where we are right now, having some exposure to those areas makes some sense.
Jim, it's good to see you. Thank you for joining us.